Welcome to Ms. Accounting Tutor's presentations. This presentation is on periodic inventory system, journal entries, inventory purchases. My name is Mary J. Collins and I'll be your host. A merchandise enterprise is a company that resells items purchased from a supplier to the public. Purchase of inventory for a resale outlet is commonplace. All merchandise purchased for resale to customers for a supplier must be kept track of in the books. These records provide information on beginning inventory, purchases during the fiscal period, and also provides information on the cost of goods sold during a set fiscal period. Let's take a look at the basic components of a journal entry. You will have the day column with the month and the day, the account title and description column, which will have one account at least debited and one credited. The credit is always indented. You will have a third line, which is a description of the transaction. It should be short and concise. You will have a debit, which is the left side. Always start with your debit. And then a credit, which is the right side. Those two must match. This is the basic components of a basic journal entry. Now, let's do purchase of inventory. On January 5th, 2014, you have the date, which is 1/5. You purchased, so you're going to do purchases. And on account, which is accounts payable, it's a liability account. Purchases is an asset account. Description, purchased inventory on account. The amount was for $500, so you will debit purchases and you will credit accounts payable. This will increase the amount of your purchases and increase your liability for accounts payable. That's the entry for the purchase of inventory periodic system. Payment of freight in. Date, January 8th, 1/8. Cash for delivery of inventory, so you're going to do freight in. Paid, so you're going to credit cash because you paid cash. Paid freight in. The amount will be $75, so you will debit freight in for $75 and you will credit cash for $75 for paying the freight. Now, purchase returns to suppliers. On January 9th, they return goods, so the accounts payable will be reduced, and it's a credit, so it'll be purchase returns and allowances, and then there'll be return defective inventory. The amount, $100, will decrease your accounts payable because of the liability account, and it will increase your purchase returns and allowances. Now, January 15th, payment to suppliers. 1/5 for the purchase of leases, so you will decrease your accounts payable. You will credit your cash, and then you will credit purchase discounts. Payment on account. $500 purchase less the $100 return equals the $400 in your accounts payable, which you will remove because you're paying it. Then 2% of that for your cash discount will go for purchase discounts. And the difference between the two will be the amount of money you pay out, which is the $392. Now, that ends our presentation. Links are for common account titles, periodic inventory system journal entries for purchases, and the C&M website for C&M students. You must have your username and password to access this particular site. Thank you for your interest in this topic, and I look forward to seeing you in other videos.